Okay, let's get into this. There's been a massive, kind of surprising shift in the market we need to talk about.
Yeah, we're looking at Opendoor Technologies.
Yeah.
The big home flipping company, the iBuyer.
And something pretty wild has happened with their stock.
Wild is putting it mildly. I mean, it's a huge turnaround story, valuation-wise. We're talking about a company that, well, really struggled for years.
Struggled to prove the basic model worked at scale.
Exactly. Investors had pretty much, left it for dead.
Right. And our sources are showing Opendoor shares are up, get this, 400% so far in 2025.
A staggering number.
And here's the real kicker for you listening. Most of that jump, it's happened in just the last couple of months.
Yeah, it's like an overnight sensation built on, well, years of not quite getting there.
That's the tension, isn't it? So this company goes from almost being forgotten
Risk of delisting even.
to suddenly having a $7 billion market cap. So the big question for us today, and for you, is what on earth happened?
What flipped the switch? And why is Wall Street suddenly so excited about a business model that historically has just bled money?
So that's our mission for this deep dive. We want to lay out for you what Opendoor actually does, what changed recently with the leadership.
And crucially, this new AI strategy that seems to be driving all the hype.
Okay, let's start with the basics then. What is Opendoor fundamentally, and why was it having such a hard time?
Well, at its core, Opendoor is basically a digital home flipper. They go to home sellers and make an offer.
The pitch is speed and convenience, yeah.
Exactly. They say, look, we'll give you a cash offer, maybe a bit lower than you'd get on the open market.
A low ball sometimes.
Could be. But the trade-off is speed. They promise to close really fast, often in just days. And importantly, the seller skips all the hassle.
No showings, no fixing leaky faucets, no painting.
None of that. Opendoor takes the house as is.
So that's the seller side. Then Opendoor gets the keys.
Right. They step in, invest their own money and time to fix it up, spruce it up.
Make it market ready.
Then they list it, aiming for a higher price. The whole game is about that difference, the spread.
And that spread has to cover everything.
Everything. The purchase price, the renovation costs, and all the costs of just holding the property while they work on it and sell it.
Those are the carrying costs, right? That's where things got sticky before.
Oh, absolutely. Think about it. A small-time local flipper might do a lot of the work themselves, knows cheap local contractors, maybe uses their own cash.
Minimizes those holding costs, sweat equity.
Exactly. Opendoor can't do that. They operate at this huge scale, holding thousands of homes.
So they're borrowing massive amounts of money.
Huge amounts. So you've got interest payments piling up, plus property taxes on every single house.
Utilities, insurance.
Right, for potentially weeks, maybe months, if the renovation takes longer or the house doesn't sell quickly.
And if their initial guess on the purchase price or the final sale price is even slightly off.
Poof. Those carrying costs just gobble up any potential profit. It's a razor-thin margin business at scale.
So it works okay for a local guy doing one or two houses.
Yeah, potentially very profitable.
But scaling it up, that's been the challenge. We saw Zillow crash and burn trying this.
A very painful, very expensive exit for them. And Opendoor, despite all the early hype, just kept posting losses year after year.
The sources are pretty clear on this, that early investor excitement, it just evaporated.
Yeah, they were left holding shares in this big asset-heavy company that was just losing money hand over fist. Couldn't seem to crack the code on making it work efficiently at scale.
And that's why the stock was in the basement for so long?
It makes sense. No clear path to profitability.
Okay, so that sets the stage. A struggling company, a tough business model at scale. But the business operations didn't magically fix themselves overnight.
No, not really.
So what changed in the last few months to cause this, 400% explosion?
It really started at the top, with governance, actually. An activist investor got involved, made some noise.
Started pushing for changes?
Exactly, put pressure on the board. And that pressure effectively led to the CEO stepping down. The longtime CEO was out.
Okay, so a shakeup. Who came in?
The new CEO is Kaz Nejatian. He's a former executive from Shopify.
Shopify. Okay, that's interesting. Known for tech, efficiency.
Precisely. And the market latched onto that. The moment his appointment was announced, the stock just took off.
Like a rocket. It was almost immediate.
It really shows the power of narrative in the market, doesn't it?
Yeah.
Here's this company basically on life support, and just the promise of a new leader, especially one with a tech background, boom, valuation shoots up to $7 billion.
Wow.
But let's be clear, and our sources emphasize this. This huge jump isn't because they suddenly started making profits. Not yet, anyway.
It's all about expectation.
Entirely. It's fueled by the belief that this new guy is going to completely overhaul the company.
And that overhaul centers around, well, the buzzword of the decade.
Artificial intelligence, AI.
Now, Opendoor already used tech, right? Their algorithms help them decide which houses to bid on and for how much.
Yes, that was already a core part of their process. But Nejatian's plan is way beyond that. It's a massive doubling down.
He wants to lean into AI much more aggressively.
Totally. Like, fundamentally transform how the whole organization works using AI. And he stated two main goals for this.
Okay, what are they?
First, cut costs dramatically. And he's been explicit that this involves, well, firing people.
Layoffs. Reducing headcount, especially in roles that involved local knowledge or manual tasks.
Yeah, getting rid of some of that human element to save money, that's goal one.
And goal two.
Make smarter decisions. Use AI to get much better at picking the right houses, pricing them correctly, managing renovations, and selling them effectively.
He's basically betting that AI can solve that scaling problem, that algorithms can do what legions of local human experts apparently couldn't do efficiently enough.
That's the core bet. Instead of relying on someone who knows the specific quirks of the Phoenix housing market or the best plumber in Atlanta.
The tacit knowledge, the stuff that's hard to quantify.
Right. They're trusting the machines to analyze vast amounts of data, predict pricing trends, optimize the renovation supply chain, figure out the best marketing strategy for each specific house.
It's an efficiency play, powered by data.
Exactly. And if you look at the potential mechanics, it's not just about setting the initial price.
No.
Think about optimizing everything. AI predicting the exact best time to schedule the painter to minimize downtime. AI finding the cheapest supplier for flooring in that specific city, like right now.
Real-time optimization across the board.
That's the dream. And if Nejatian pulls it off, if the AI really delivers that level of efficiency,
then maybe, it just may.
they could finally break into the black, post that elusive full-year profit everyone's been waiting for.
But hang on, let's push back on that a little. If so much of real estate is hyper-local, you know, knowing that this neighborhood loves granite countertops, but that one 3 miles away prefers quartz.
Nuance.
Exactly. Can an algorithm truly capture all that? Isn't there a risk the AI just smooths over the important local details, that it oversimplifies?
That is the central question here, and it's why this is such a massive gamble.
High stakes, indeed.
The upside, if he's right, is huge. If this AI model works better than humans at scale.
Then they could expand way beyond the limited cities they're in now.
Potentially, yeah. Tap into a much bigger market. Huge opportunity. But, and it's a big but, there's enormous risk baked into that if.
Because AI is hot on Wall Street right now, everyone's excited about it.
Super hot.
But the sources we're looking at, they're saying, hold on, it's far from guaranteed that this AI-first approach is actually the silver bullet.
Far from it. And this transition itself isn't cheap. They have to invest heavily in the tech, restructure the company. That costs a lot up front, whether it works out or not.
Okay, so there's execution risk. But you mentioned something else, idiosyncratic risk.
Yeah, that's the really scary part, I think. Let's say this big AI overhaul fails. Let's say the algorithms just aren't as good as they hoped.
They make bad buying decisions or misjudge renovation costs.
Exactly.
Yeah.
The problem is, what do they fall back on? They will have let go of potentially thousands of employees.
The people with the local knowledge. The human expertise.
Right. That institutional memory about which contractors are reliable in Dallas or which neighborhoods in Tampa are riskier bets, that's being deliberately discarded.
Wow.
If the AI fails, how do you rebuild that human knowledge base? It might be impossible. You can't just easily hire it back.
So they're essentially burning the bridges behind them.
That's a good way to put it. It's an all-or-nothing bet on the AI strategy. The company's entire future seems to hinge on this single massive pivot working.
And if it doesn't?
It's probably not just another bad quarter. It could realistically be the end of Opendoor as a viable business. That's the idiosyncratic risk failure is potentially fatal.
Okay, so bringing it back to you, the listener, maybe watching this stock price soar. What's the takeaway?
Well, the sources are pretty unanimous on caution. Right now, investors seem to be pricing in the absolute best case scenario.
Assuming the AI works perfectly, solves all the problems.
Instantly, yeah. And while the stock might keep going up, momentum is a powerful force, especially with a hot tech story.
Sure, FOMO is real.
Definitely. But the prudent advice seems to be, wait and see. Watch from the sidelines for now.
Wait for actual proof.
Concrete proof. We need to see the numbers change. Are the profit margins, the spread, actually improving? Are carrying costs going down?
Yeah.
And the big one,
Can they finally achieve a full year of profitability?
until we see that hard evidence, this rally is built purely on hope and hype around a new CEO and a trendy technology.
So, to wrap up this deep dive, we've seen this incredible 400% stock surge for Opendoor.
Driven not by results, but by the promise of an AI revolution under new leadership. It's a fascinating case study in market psychology meeting tech speculation.
And that leaves us with a final thought for you to chew on. We see how fast a stock can climb when investors fall in love with a story, especially an AI story.
Yeah.
But it raises a deeper question, doesn't it? When a company decides to essentially fire its human expertise, its complex, nuanced, local knowledge,
And replace it all with algorithms.
are they really building a leaner, smarter future? Or are they just creating a different kind of fragility? What's the hidden cost of losing all that human experience?
And maybe more importantly, if the tech gamble fails, can that lost knowledge ever truly be recovered? Something to think about.
Definitely food for thought. We'll catch you on the next deep dive.